big brokerage houses like Goldman Sachs, JP Morgan's will be the ones that borrow the gold. They then take the borrowed gold and they contribute it to the ETF. So the ETF is sitting there on borrowed gold. And when people ask, well, where's the gold? They show them a vault full of gold. Except the title to the gold still is with the central bank as part of the lease deal. So if at any point in time the authorized participant, the Goldman Sachs or JP Morgan, get into difficulty, the central bank will go to the ETF and say, here's our lease contract, please send the gold back to us, because it belongs to them.
Wow.
And this is where everybody is getting conned into this bullshit of the ETFs. They think that paper gold is the same thing as real gold, and it's not.
Welcome back to Liberty and Finance and Reluctant Preppers. We're delighted to have this returning guest. Nick Barisheff is the CEO of BMG Group, which is located in Canada and has made records for being the first to establish certain important types of physical metals funds. Nick, thanks for joining us back here again on Finance and Liberty.
My pleasure to be with you again.
We wanted you to talk to us about a recent article that you wrote called Understanding the Current Investment Reality. And folks, we'll put a link to this article, which is very readable and it's full of very interesting charts that really bring some perspective to what we're facing right now in this virus pandemic and in the market volatility that we're facing, and the fact that many people have not received the guidance over the past decades on how they could diversify and hedge themselves by using gold. Nick is also the author, as you might know, of the book $10,000 Gold, and we're bound to talk about some of the concepts from that, given the profligate fiat currency environment that we find ourselves in. But Nick, if you could start us talking about what got you to write the article, Understanding the Current Investment Reality.
Well, it was kind of, the mainstream media was starting to irritate me because they're recommending to investors, like all of them, stay invested, don't trade. Everything's going to correct momentarily, and you'll miss the bull run. Mm-hmm. And that to me is bad advice, because the issue is we know two factors. Most industries are either shut down or the sales have dramatically dropped, other than delivery businesses like Amazon, and everything else is non-existent. The corporate buybacks, which were a main driver of the stock market, are over. They've stopped. And the government is printing an enormous amount of money. So when you look at that comment, there's a lot of other unknowns, but that combination alone tells me that the market isn't going to do well, because it has to be based on earnings eventually. So the Fed can throw money at it all they want, but there are no earnings there, and there won't be for a long time. If we were to have a cure for the coronavirus, the economy is just not going to snap back. There's many of the small businesses, the restaurants, the sole proprietorships and whatever. I think there's many of them that will never come back. Mm-hmm. And to stay invested is ludicrous. So for people that don't understand gold, they should at least go to cash. And if they understand gold, try and buy it while it's still available. Or funds, we can still buy gold for the moment. I don't know how much longer that's going to last. because once the above ground supplies are gone, that's it. Mine production is at a standstill. Mints are not operating, and even Briggs has trouble delivering bullion back and forth. So it's at a standstill. And if people haven't got bullion, they may not be able to get it in the near future.
The timeline that you talked about in this section of your article, where you talked about how long it may take for earnings to come back that would justify any kind of multiples, that could justify any kind of recovery of the major stock markets for people to stay invested in. You know, a lot of people, if you look at the baby boomer generation, a lot of people are nearing late career stage and close to retirement age, and they're very concerned about that a lot of their retirement funds, whether it's in 401ks or pensions that are invested in the market, are basically dependent upon the market's recent levels. But your argument is, if you showed us the long chart in your article about how great recessions have happened in the past and how long they take to play out, and the long-term effects they have on the markets. Can you touch on that?
Well, that's right. The issue is that when we have an inordinate, correction like we've had many times, in many cases it takes 20 years to break even. And what people don't understand is that their portfolio loses 50%, which is very realistic. I think it might be higher than that. Then you need 100% in order for your portfolio to break even. And the likelihood of that happening in their lifetimes is next to zero.
And that's in an ordinary major recession. But if people, and even some of the major investment banks have been coming out and predicting that what we're going to see here is going to be significantly worse than the Great Depression of 1929 to 1933 and on. What was the length in that? In what kind of a timeline for recovery would be looking for if that scenario plays out, as some of the major investment banks are talking about?
Well, without taking inflation into account, the 1929 crash took over 20 years to correct. So that's the issue. If you take inflation into account, and it's almost double that amount of time. So the issue is that's one thing for insurance companies and institutions, but individuals, particularly the baby boomers, they don't have 20 years to recover. But the other thing that the missing point is it absolutely doesn't make any sense to hold a market that's going to decline. It's about as sure a bet as you can make that the market is going to decline from this. It was at a bubble, and it's going to get down to serious, undervaluations. And if you are in cash or gold, you're going to be able to buy the same things you currently own now for 50 to 70% off. So just wait to that point. Get your money off the table. What are you staying in for a 3 to 4% dividend when you can have a 50 to a 70% capital loss?
And even some of those dividends are getting canceled. My wife and I were owners of.
I think exactly that. There's no sure thing, and many industries are struggling. They need government bailouts just to stay afloat. And to the smaller businesses, like I think the vast majority, just aren't going to recover. And the consequences of not recovering is all those unemployed people are not going to be spending money buying houses, buying cars, going on vacations, going to restaurants. All that's not going to happen.
In the next section of your article, you went on to show performance decade by decade of gold versus stock markets and that sort of thing. And it took me back to a retirement planning seminar my wife and I attended a couple months back. And I sat there just biting my tongue and biting my cheek through about 3/4 of the seminar. And I finally started raising my hand to the point where I became kind of like the problem child in the room. But the presenter, who is a very well-intended and quite experienced personal financial planner, was explaining to people about how yes, markets have their ups and downs, but you just stay in, you stay invested, and you'll ride out, and you won't miss the good up years by trying to time anything. Just stay in the market. And they did not. They talked about annuities, talked about market, but did not talk about gold as an alternate swim lane you should be seriously considering as part of your overall portfolio.
Well, this is the thing is, you see, on a normal basis, if you allocate 10 to 20% of gold to your portfolio, it'll reduce the volatility of the portfolio, and it'll improve the returns of the portfolio. And the reason it does that is because it's negatively correlated to financial assets. So when stocks and bonds are going down, gold is going up. So it balances things out. But during periods of major declines, like I have the table in there, those were the major declines in the equity markets, the ones that were at or over 20%. And in each time, gold was up. So that the lesson from this is that when you're facing a major equity decline, hold gold. It'll be up. Then when the market finishes correcting, sell some of the gold and buy the equities at that point at 50 to 70% off. There's no point holding them till they become worth 50 to 70% less than they do today. What's going to happen if you look at the one chart that compared the markets in 29, 2000, and 2008? You see that chart? Where everybody is going to get suckered, because if you look at 1929, the market went down about 40% in 1929. Then it rallied 50% to 1930. And from that point, everybody was cheering and clapping that the bear market was over and new bull market has begun. But from 1930, the market declined a further 86%. That's what's going to happen this time. There's going to be bear market rallies, and everybody will get their dead cap bounces or suckers rallies, whatever you want to call them, and they'll breathe a sigh of relief and stay in, and it'll just sucker most people to stay in and take the big losses eventually.
Is a lesson to take from that when you've passed the peak of a bubble market and you're in the bear phase, that rather than that, in order to stay contrarian, to be successful, you need to be contrarian. In order to be contrarian, you need to realize that when other people are feeling the relief of a rally within the bear market, you should be seeing that as an opportunity to get out with as much of your hide intact as you can, your capital intact as you can.
Right. Exactly. And that's the thing, but most people won't be able to face that, and then they'll get suckered in the bear market rally and then stay in for the big part of the decline and keep waiting for another rally, which will never come. But you see the opportunity, if you look back at the 2008 scenario, we studied that in great depth because that's how the founding principles of our hedge funds were based. That in 2007, if you held 100% gold and held it to, now in that case, that decline ended in March of 2009. So if in 2009 then you sold some of the gold that you held, bought REIT stocks and bonds and so on, you're buying the assets at 50% discount. So when the rally did happen, your portfolio is rallying from a low. So you're not simply making up losses. You're actually rallying. And for the sake of not being invested for whatever this might take, 1 year, 2 years, 3 years, you're better not losing your life savings and just waiting and reinvesting then. So that's where I ended the article, that people need to understand. Most people don't understand gold. We're talking to institutions that had major unfunded pension liabilities before the coronavirus issue.
Right.
And now the pension funds have got a double whammy. Number one is that there are no longer employees working that are contributing to the pension fund. And the assets of the pension fund have declined by about 30% at least.
And a lot of the businesses that the stocks that the pension fund may be invested in are going to be looking forward, according to your projection, the viewpoint that you're taking is that many companies are going to be hurting for a long time in terms of before we see a resurgence in consumer activity.
Well, where it becomes worse is that some of the biggest pension funds have significant real estate holdings, so they own the regional shopping centers. Well, the regional shopping centers are closed, and the small stores in there are probably never going to open again. So what's a regional center worth when you have no tenants paying rent?
And that's what's behind a lot of people's pension funds, pension plans that they think are self-sustaining, but they are actually built on these assumptions and the other part I think that you added to that discussion, which we've talked about this a few times with different guests, but your point that you just made was one about the current contributions to the plan from current workers aren't happening either because everybody's furloughed.
Yeah, it was bad enough that because in the pension plans you've got the distorted ratio of retirees to workers. So when pensions were started originally, you had 50 workers per retiree. So you had a lot of people contributing to the plan and only one taking out. Now this thing is reversed, and there's more retirees than there are workers. And now all the workers have either been laid off or fired. There's no workers contributing to the pension plan at all.
Well, Nick, I think you've outlined for us a lot of the serious factors that are not being discussed by most people's financial advisors and that most people aren't aware are underlying the future dismal recovery prospects for their pension plans and their portfolios. But your original book that you wrote a few years ago, $10,000 Gold, Why Gold's Inevitable Rise is the Investor's Safe Haven, was already foreseeing a remarkable increase in the price of gold. But from what I understand it, you're saying that the factors that led you to that are present even in much greater ways today.
That's right, exactly. And that's been the problem. People didn't appreciate that the stock market wasn't rising because of fundamentals. It was rising because the Fed was throwing a lot of money at it. The companies were borrowing the money and buying back their shares, and therefore the CEO bonuses were maximized, but there wasn't any fundamental underlying reason for the rally. And it was many experts were talking about how this stock market was unsustainable. Nobody contemplated that the pin that would break it would be the coronavirus. And it's the results of the coronavirus are much worse than what anybody contemplated. I mean, I think it's absolutely ludicrous to have shut down the entire global economy. They've never done that before. Even in the 1918 flu, it was still business as usual, and millions of people died. They could have spent the money on hospitals and ventilators and whatever, instead of just shutting down the economy. Then the people that would need the support would have it.
Yeah, there's been a lot of controversy around not only the origins of this crisis, but the way that it's been managed in such just a catastrophic way for people's personal lives and financial lives. And there's lots of concern about, was that the right way to handle it, and a lot of mystery about why there's been so much global alignment among so many governments of suddenly taking this approach of basically shutting down the world's economies all at the same time.
And the difficulty of coming out of it is even if the restaurants, for example, were to open tomorrow, who's going to go there if they're unemployed? You know, it's kind of ludicrous. So and that goes across the board, whether it's resort properties, hotels, airlines. Those are all big sectors of the economy. The car dealers were overloaded with inventory, in some cases as far back as 2018 inventory that they're overloaded with, and now have been forced to shut down. What's the bank going to do? Repossess the inventory and having an auction? They're already giving them away.
There's another aspect of the shutdown global economy that directly impacts at least one precious metal, being silver. Daniel Lombardo submits the question, says, I've asked this question with others before, but I haven't really received a clear opinion from anyone. With industrial demand being the biggest driver of price, how do you see it affecting silver during and after this pandemic?
Well, the issue is gold, silver, and platinum all have historic uses of being monetary assets. Gold is primarily a monetary asset. Silver is 50-50, industrial commodity and monetary asset. And platinum is about 75-25, commodity, monetary asset. So what happens is that when there is no more gold to buy, even at $10,000 an ounce, people will move to silver. And the price of silver needs to come up. The long-term mean in terms of gold-silver relationship would mean that the price of silver should be about $37 an ounce today, just to be equal to the long-term mean. But when you can't buy gold anymore, because that'll be the first thing to go, then people will switch to silver, then switch to platinum. And platinum should be several $100s above gold, and it's several $100s below gold. Never happened before.
There we have some more questions. Actually, there's quite a few questions that have to do with, I guess, finding the right price or the true price for precious metals, physical precious metals. So many of them are asking, as premiums increase, how or where can we see what the retail price of physical metals is each day? The COMEX price is easy to find, but we all know it's becoming more unreal day by day. We need somehow to be able to see the measure of the real price. This is from viewer Brendan.
Okay, to my mind, the closest thing you can get to real physical prices is that if you go to the website 24 Hour Gold, on there they have a section that lists the sales on eBay and Amazon. Okay? So those are public sales. Those aren't asking prices. Those are the prices that people have sold 1 ounce gold coins, 1 ounce silver coins for. Okay? So if you want a realistic physical price, I think that's as close you get, because that's a very broad market. People are buying it for those numbers.
Okay, we'll put a link to that in the we'll put a link to that in the description.
A silver coin is about $30 an ounce the last time I looked.
Related question, Greg Phelps asks, do you believe that when supply chain issues normalize that the premium price will come down, or will they remain high due to investors leaving financial markets and buying up more gold and silver, which would drive premiums even higher?
Well, the issue here's which I've been promoting to the pension funds. In the world, there's only 3 pension funds that have any gold. The Dutch pension fund, the Texas Teachers Pension Fund, and 2 Canadian funds that we've sold a relatively small amount, but nevertheless they bought some gold. Now, to get an impression for this is that if the Ontario Teachers Pension Fund, which is a pretty big pension fund in Ontario, but not that big on a global scale, if that fund was to allocate 5% to gold, they would need to buy $8 billion worth of gold. Do you think you can buy $8 billion worth of real gold?
So what, based on your experience, what would happen if someone tried to do that? What impact would that have on the current market?
Well, all the above ground supplies would be gone, because then whatever above ground gold would be there. So what you're going to get is one pension fund that has the balls to go against the grain is going to be the only one that gets any gold. And then the public and everybody else, is out of gold until the supply chains get back up. But for the supply chains that get back up, the workers have to go back to the mines, which they're not going to do because of the coronavirus fear. The mines have to produce the gold. The doré bars have to be transported by Brinks, by air, to a mint. The mint has to refine the doré bars into good delivery bars, and then they can become for sale. How long is that going to take? Because that's not happening right now at all.
Looking at the other end of this, Billy Boner asks, if gold reaches $10,000, what are the ramifications to the dollar, the prices of goods, services, food, and energy?
Well, it means then we're probably in a hyperinflation, because for gold to be 10,000, then the dollar has probably lost value. And if they go ahead and print $2 trillion and hand it out like candy, then it's going to be worth less. It's that simple. And by the way, the $2 trillion is only how much money they need in the immediate future. They keep this up, the $2 trillion will become $6 trillion.
Yeah, that's what they were saying. Even if you count the forgiveness of interest and so on that they're planning with some of these, is that even that original $2 trillion has built into that plan to grow to $6 trillion itself. Let alone that they're talking about.
Well, they haven't built anything in for the landlords and banks. My background is in real estate, and you've got an enormous amount of commercial real estate where now the tenants aren't going to pay their rent. And when the tenants don't pay the rent, then mortgages go into default. But the main message I have for people is that if you have gold and silver, then you're some of the lucky few, and many of your people are preppers, so I assume they have that. For those that don't, I would move on that quickly while you still can.
There's a question here about a quote on private gold holders that own most of the world's mined gold rent their gold via paper contracts and don't sell it. Can you please comment on this statement and help us understand the mechanisms for making profit from renting gold?
Well, gold is leased by primarily the central banks, and it's not something that individuals can release their gold. The thing that's distorted the markets, and this is where the leasing problem comes in, is just like when you lease anything, you lease a car, the title to the car stays with the lessor. You get the right to use the car, okay? But you never gain ownership of the car. So in gold leasing, the same thing happens, and this part people don't understand because it's ridiculous. And that is, a central bank will lease gold. Typically, the big brokerage houses like Goldman Sachs, JP Morgan's will be the ones that borrow the gold. They then take the borrowed gold and they contribute it to the ETF. So the ETF is sitting there on borrowed gold. And when people ask, well, where's the gold? They show them a vault full of gold. Except the title to the gold still is with the central bank as part of the lease deal. So if at any point in time the authorized participant, the Goldman Sachs or JP Morgan, get into difficulty, the central bank will go to the ETF and say, here's our lease contract, please send the gold back to us, because it belongs to them.
Wow.
And this is where everybody's getting conned into this bullshit of the ETFs. They think that paper gold is the same thing as real gold, and it's not.
That's really remarkable. So people that are buying into SLV or GLD and thinking that they have some real gold out there somewhere need to be aware of that.
No. You see, if people stop to think, like for example, in our funds, when money comes in from investors to the fund, we then go ahead and buy gold for that amount of money. Okay? But in the case of the ETFs, how do they get their gold? Well, an authorized participant isn't going to go to the market and buy gold, contribute it to the ETF at net asset value, get shares from the ETF at net asset value in order to sell to their clients at net asset value. Because there clearly isn't any money in that. And people don't stop to think of where did they get the gold from. Well, they borrowed it. They borrowed the gold from a central bank, contributed it to the ETF, and the ETF is sitting on a pile of borrowed gold. And the central banks still own it. And all the people that buy ETF shares think they own it. Someone's going to lose, and it's not going to be the central banks.
Wow. Nick, we're just grateful that you've joined us here again on Liberty and Finance and Reluctant Preppers, and thank you also for having written $10,000 Gold, the book, as well as your most recent article that we're going to put a link to in the description of this video, and also for having started your physical gold fund, and for just giving us such a clear-cut, down-to-earth, realistic view of what's really the truth about what's going on in this arena, because so many people's livelihoods, their retirements, their ability to leave anything for their children and grandchildren is at risk here because of falsehoods they've come to believe or intentionally been misled. And we're just grateful for you setting the record straight in so many of these important ways.
Well, I'm glad. I hope I can help a number of people, and that we all come out of this in somewhat intact.
Thank you very much, Nick.
Okay, thanks, Dunnigan.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.